And it's week 3 of earnings season. We're showing the spotlight on CSL, JB Hi-Fi and Telstra. Paul, CSL.
Yeah, let's start off with CSL. This is a cracker result. NPAT just over 1.9 billion US dollars, up 11%. The upper end of guidance, Peter, and adjusted for constant currency, which takes out the impact of foreign exchange, up 17%. Better than expected and on a good result. Sales up 11%. That was also positive. And a very strong performances in immunoglobulins, right?
Well pronounced.
I think I got right. Final dividend of $1 per share, about $1.48 for Australian shareholders. A little lower than expected, but still up on last year. And probably the most important part of the CSL result was actually guidance for next year, Peter, with this suggesting profit growth of between 7 and 10%. And a range of that would take it to 2,050 to 2,110 million US dollars. That was ahead of where the market was expecting.
I think Homer Simpson would say, "Is there anything CSL can't do?" Let's go to the next one. The highlights.
Yeah, well, and look, we talked about the sales growth with some of the immunoglobulins and the albumin therapies products, especially product sales. The Seqirus flu business, which they bought a couple of years ago, that made a contribution to profit, a bit of a positive. They opened 30 new plasma collection centres in the US. They've got 40 planned for next year. That's really important to actually continue to be able to sell these goods. You've got to be able to collect or sell these
and
blood
people
products.
don't think about that, do they?
You've actually got to be able to collect the plasma. And their guidance for next year included some headwinds about some changes to their selling model in China. Now, this is basically see them sell directly rather than through third parties. Hasn't an accounting change. The market perhaps feared that was going to have a bigger impact. And CSL said, no, we know what that's worth now, and it's not too bad. Some negatives, look, expense growth, as you'd expect for a company that's growing, and inventory growth, so a bit of a pickup in inventories. Operating cash flow was actually down by 14%. And some of the profit growth, in fairness, was due to a lower tax rate. But the market liked the result, Peter, on the back of really the outlook for next year. And CSL maintains its title as Australia's best company. There's no doubt about it.
And you've always liked CSL. Is it a buy here, Paul, or is it a hold?
Look, own CSL, hang on. If you don't own CSL, it should be a core part of people's portfolio. It's actually the third biggest company now by market cap. People forget that. Look, you may not buy it today, but in market weakness and sell-offs, CSL's a stock to put on the portfolio watches, despite that it's trading on pretty crazy multiples.
Okay, let's go to JB Hi-Fi now.
Look, again, I'm dealing with great companies here, at least the first one, CSL, JB Hi-Fi, I think Australia's best retailer.
I agree.
Reported really strongly, net profit up 7.1% to just under $250 million. That was ahead of their guidance and the market like that. Sales up 3.5%, right on guidance. So that's not a huge number, but Peter, in retail world, that's not too bad.
Yeah,
and,
struggling
there
economy.
was also some positive comparable store sales growth. Dividend 142 cents per share, up 7.6%. That's pretty JB Hi-Fi still a pretty attractive yield. JB Hi-Fi's really got two major businesses. It's got a small business in New Zealand, but it's mainly the consumer electronics business that JB Hi-Fi stores we're all familiar with. Plus it owns The Good Guys, which is an appliance business, and that had an improved performance. The Good Guys business did look like, when they bought it a couple of years ago, as a bit of a weak acquisition, but there was an improvement there. They've guided to sales growth next year of up 2.2%. And they've reported a reasonably strong start for July, at least for the JB Hi-Fi Australian business, which is really a benefit of some of the stimulus measures we've seen, lower interest rates, but also the impact of those tax cuts. And the market liked it. The shorters have been pretty active in JB Hi-Fi. There are still big short positions, and the market liked the result.
Okay, let's now have a look at Telstra.
Yeah, the other end of the spectrum, a business that's not growing, but yet has done very well in the market in the last 12 months. I think because the market got too low. But these numbers, although they don't look too good, were all pretty much bang on expectations. So total income down 3.6% to $27.8 billion. Their reported EBITDA down 21.7% to $8 billion.
This does not sound like a good story.
Underlying EBITDA down 11.2%. And reported net profit after tax down 39.6% to $2.1 billion. But they are in line with expectations. And their final dividend, 16 cents per share, fully franked, final of 8 cents. Again, unchanged from last year, but pretty much with expectations. Going to some of sort of the highlights and the negatives. Look, Telstra, it is continuing to win share in both mobiles and with NBN customers. It is making some progress with 5G and got some pretty exciting plans in terms of the 5G rollout next year. Look, the big issue for Telstra, of course, has been the impact of the NBN. Now, it's an impact of NBN on ongoing revenue as people switch out of fixed line phones and switch out of fixed line broadband and use the NBN. They put Telstra or Optus or someone in front as a retailer, but Telstra ceases to be the wholesaler. So that's what NBN is doing. It's now effectively the wholesaler in broadband, and retailers don't make a big margin and selling you NBN packages. So that has a huge impact to Telstra in terms of ongoing revenue and an earnings impact of about $2.5 billion. So a couple of years ago, they announced a program to take out costs. They need to take out about $2.5 billion by FY22. They say they're up to about 1.17, so they're making some progress. And probably the most positive statement that Telstra made was that although EBITDA is going to fall next year, they say when you adjust for the NBN headwinds, there's actually about $500 million of growth there.
So you're saying if you could take out the whole NBN effect, the business is growing, and that's going to be important going forward.
That's what they're saying. So that's what they're forecasting. That all said, just on a headline level, so it's still income is still going to decline next year. So they're forecasting that. It was 27.7 this year. They're saying next year in the range of 25.7 to 27.7. And they're also saying EBITDA will also decline because this year it was 7.8. They're saying next year around 7.3.
Will the dividend be safe, Paul?
I think the dividend looks okay, at least next year. And I think that Telstra probably gave some confirmation that this year's payout ratio is lower than their target. So I think the dividend should be okay. Where there's still pressure is in the mobiles market and so-called ARPU. This is the average revenue per user. That's still declining. So this year down from $56.33 down to $54.77. Telstra's forecasting that still to decline next year. And that's functioning, maybe the competition in the market, but also we don't pay now excess rates. We all just have eat as you want bundles. And and to be honest, Telstra's probably better off there following the fact that TPG, decided not to go ahead with its own network, and that's been one of the reasons why Telstra's gone up this year. And they're still saying the peak impact of the NBN is expected next year. So look, an okay result from Telstra. I guess people are saying, look, it's a fairly safe investment.
And its rivals are not impressive.
Its rivals aren't that impressive. It's a 16-cent dividend, 4% yield. It's okay, but would I be rushing in to buy Telstra near $4? Probably not. Would I be holding on if I had it from an income portfolio? I think so.
And you'd probably buy it if it sold off.
If
you're chasing dividend.
If you're really bullish on 5G and the fact you think that they can actually convert that and make something out of it, and they are making some progress, and they don't have it, the competitors aren't. Look, maybe that could be yet the turnaround, but look, I still got a feeling it's Telstra, and I think you don't look for too much, and I think that's the way you should approach it.
One quick one, earnings season so far, better than expected?
Look, pretty good. Look, and certainly the first couple of weeks, as we get into it, I've just been a couple more negative results today and the last day or two, but overall, looking a little better, and I think maybe because expectations have been pretty low.
Okay.